Factor how Visa actually makes money. Hey, what's up everyone? Welcome back to the channel. Every time you tap your card at checkout, there's a whole invisible chain of companies getting paid before that transaction even finishes processing. And one of the biggest winners in that chain every single time is Visa. Here's a stat that surprises a lot of people. Visa isn't actually a bank. It doesn't lend you money, it doesn't set your interest rate. And if you miss a payment, Visa isn't the one chasing you down. So if Visa isn't lending money, how does a company with a market cap in the hundreds of billions of dollars actually make its money? In this video, I'm breaking down exactly how Visa's business model works, walking through what happens in the few seconds after you swipe your card, and showing you the real numbers behind one of the most profitable business models in the entire world. Let's get into it. First, let's clear up a common misconception. Visa doesn't lend money at all. This is the single most important thing to understand about Visa's business. When you think credit card company, you probably picture the bank that sent you your card, charges you interest, and shows up on your statement. That's not Visa. That's your issuing bank, companies like Chase, Bank of America, or Capital One. Visa is what's called a card network. Its actual product is the infrastructure that connects merchants, banks, and card holders together, and processes the transaction in the background. Visa never touches your credit risk, meaning if you never pay your credit card bill, that's a loss your bank absorbs, not Visa. This distinction matters enormously because it means Visa's business is almost entirely fee-based and involves none of the lending risk that makes banking a genuinely risky business. That's a big part of why this model is so profitable. Now let's walk through what actually happens when you swipe a card. Say you buy something for $100 at a store. Here's the chain of events and where the money actually goes. You pay the merchant $100. The merchant doesn't get to keep all of that because they agreed to a merchant discount fee in exchange for accepting card payments. Since accepting cards drives higher sales volume than requiring cash, that fee gets split up. The acquiring bank, meaning the merchant's bank, typically keeps a small acquiring markup, often around 25 cents on a transaction like this. The much bigger chunk, commonly around $1.75 on a $100 purchase, gets paid to the issuing bank as what's called the interchange fee. This interchange fee is set by the card network, in this case Visa, because it would be incredibly inefficient for every single bank to negotiate rates individually with every merchant. Then, separately from interchange, the issuing bank pays Visa directly for using its network. As a real example, Visa charges something like a 0.1% assessment fee, plus a flat fee of about 2 cents for every single swipe processed on its network. That might sound tiny, but remember, Visa processes hundreds of billions of transactions a year, so those tiny fees add up to tens of billions of dollars. One more detail worth knowing, the issuing bank actually pays the merchant before the cardholder pays the issuing bank back. That gap is exactly where the lending risk lives, and it's entirely on the bank's side, not Visa's. Let's break down Visa's actual reported revenue lines. Visa's real financial reports split revenue into 4 main categories. Service revenue is generated based on the overall dollar volume of payments made using Visa cards. Data processing revenue comes from the number of transactions Visa actually processes on its network, separate from the dollar amount. International transaction revenue comes from cross-border transactions and currency conversion. And this line earns more per dollar of volume than the others, since currency conversion and cross-border fees stack on top of standard processing fees. And a 4th category, simply called Other Revenue, includes things like advisory services and what Visa calls value-added services, things like fraud prevention tools, data analytics, and services it sells to banks and merchants beyond basic transaction processing. Here's the real scale of this. In fiscal 2025, those 4 revenue lines added up to about $55.8 billion combined. But Visa also pays out huge incentives to banks and partners to keep them using Visa over competitors like MasterCard. And those incentives came to about $15.8 billion that same year. Subtract that out, and Visa's net revenue landed right around $40 billion, up 11% from the year before, producing $20.1 billion in net income. Just to put that profit margin in perspective, that's roughly half of net revenue turning directly into profit, which is an extraordinary margin for a company processing this much volume. The fastest growing part of the business might surprise you. You'd think the core swipe fee business would be where all the growth is, but it's actually the value-added services category, the other revenue line that's been growing the fastest, jumping around 27% in a recent fiscal year. This includes things like fraud detection tools, tokenization services that make digital payments more secure, and data and consulting services Visa sells directly to banks and large merchants. There's also Visa Direct, Visa's real-time money movement platform that handles things like instant payouts, peer-to-peer transfers, and business-to-business payments outside the traditional card swipe model entirely. Visa Direct processed over 12 billion transactions in a recent fiscal year, growing 27% year over year. This matters strategically because it means Visa is expanding beyond just processing card swipes and into being the infrastructure behind a much broader range of digital money movement, which protects the business as payment habits keep shifting toward things like instant transfers and digital wallets. How dominant is Visa's actual market position? This is worth understanding because it explains a lot of why the business is so durable. Visa held roughly 70% of US card purchase volume in a recent year compared to MasterCard's share sitting around 30%. Visa also had close to 4.9 billion payment credentials, meaning cards and digital tokens, in circulation, reaching more than 150 million merchant locations worldwide. Quarterly payments volume recently surpassed $4 trillion for the first time in the company's history. This scale creates what's often called a network effect. Merchants want to accept Visa because so many consumers carry it, and consumers want to carry Visa because so many merchants accept it. That self-reinforcing cycle is a huge part of why it's genuinely difficult for a new competitor to break into this space. Even with a better technology, since the value of the network comes almost entirely from how many people are already using it. So why is this considered one of the best business models in the world? Pulling this all together, Visa makes money on a tiny percentage of an enormous, constantly growing pool of transactions, without ever taking on the credit risk of actual lending. It doesn't need factories, it doesn't hold significant inventory, and its infrastructure, once built, scales to handle enormous additional transaction volume without a proportional increase in cost. That combination, high margins, a minimal risk, and a self-reinforcing network effect, is exactly why credit card networks like Visa and MasterCard are frequently cited as some of the most profitable, resilient business models that exist. So that's the real breakdown of how Visa makes its money, collecting small assessment and processing fees on an enormous volume of transactions, setting the interchange fees that flow between banks, growing its value-added services and real-time payments business, and doing all of it without ever taking on the lending risk that banks carry. If you found this interesting, the natural next comparison is looking at how Visa's business actually differs from a company like American Express, which is both the network and the lender at the same time, a genuinely different and riskier model worth understanding on its own. If this helped you understand how this industry actually works, drop a like, subscribe for more videos breaking down how big companies actually make their money, and let me know in the comments which company you want me to break down next. Thanks for watching, and I'll see you in the next one.